Hi, my name is Mary, and I will be guiding you through a series of videos covering the calculation of financial valuation metrics using actual market data. While other videos will deal with the theory and definitions, in this video I will focus on the practical work. You may have heard about a stock's beta in multiple opportunities, and you are possibly familiarized with it as a measure of systematic risk, or more precisely, a stock's sensitivity to market fluctuations. In this video, let me walk you through the steps needed to calculate the market beta of any stock, relying on market data. Let's get started. Before we begin, we will need to download the monthly prices and values for a stock of your choice and the market portfolio. Generally, we rely on S&P 500 index as a proxy for the market portfolio, so you may download the monthly values for GSPC, which is the ticker of the index. Alternatively, you could download the monthly values for SPY, which is an ETF that tracks the S&P 500 index. In this video, we will choose Microsoft as the stock we will evaluate. Its ticker is MSFT. You can calculate the market beta using different frequencies of data and over different windows of time. For that reason, after calculating beta, keep in mind to report it along with your calculation's broad details. In this video, we will calculate Microsoft's beta using 5 years of monthly returns. More specifically, we may refer to this beta as a 5-year monthly beta to avoid any confusions. You may be wondering where to obtain the monthly prices needed for your calculations. You could obtain these data from multiple online sources such as Yahoo Finance, Bloomberg, or NASDAQ. If you are a bit more tech-savvy, you may also download them using Python or another software. Once you have downloaded the monthly prices, we can calculate the monthly returns. In this video, we have downloaded monthly prices starting in January of 2020 until December of 2024. Calculating returns is quite simple. For example, to obtain Microsoft's return for the month of February, you divide the price of Microsoft in February by its price in January, and you then subtract 1. You may be more familiar with the following formula, where you divide the monthly dollar gains or losses by your investment. If you expand the formula, you will notice that it is exactly the same formula that we are already using. Let's continue calculating Microsoft returns for the month of February of 2020. If you had bought the stock in January at 163.15 and you sold it in February at 155.27, you would have lost $7.88. Dividing the $7.88 by your January investment of $163.15, you realize that the return is minus 4.83%. A similar logic applies to the calculation of the returns for all other months. Next, you can go ahead and select all the returns we have calculated for Microsoft. Let's give this entire range of returns the name MSFT RET by typing this name in the name box, which is located to the left of the formula bar. Doing so will make everything easier as we continue our calculations. Let's do the same for the market index returns. You can select all the values and then name the selection as SPRET. A stock's beta is calculated dividing the covariance between the stock returns and the market returns by the variance of the market returns. Keep in mind that we are using S&P 500 as the proxy for the market portfolio. Doing so is common practice. In cell D8, you can easily compute the covariance between the stock returns and the market returns using the Excel command covariance.p. In cell D9, you can then compute the variance of the market returns using the Excel command var.p. You may replace the .p particle to .s if you would like to acknowledge that you are working with sample data instead of the entire population data, although this distinction becomes less relevant the larger our sample is. Finally, in cell D10, you can obtain the beta by dividing cell D8 by cell D9. Since we have already gotten this far, we can quickly calculate a few additional metrics. For instance, the average return of S&P 500 in cell A3 using the average command. We generally consider the arithmetic average of historical returns also as the expected return for financial decision-making. We should now annualize this expected return, and when doing so, we must account for the compounding effect, so we use the following formula. For your convenience, the actual Excel formula is shown in cell B6. The difference between the market portfolio expected return and the riskless rate is generally considered the market risk premium. We have calculated this metric in cell F6. In short, according to this data, it seems that investors require about a 10.87% premium to move out of the safe haven of treasuries and into the riskier waters of equity. This value is relatively high given that historically, the market risk premium is usually within a range of 5 to 6%. Finally, we may alternatively use the slope command in Excel to calculate the beta relying on a single Excel command. Let's recall that the market beta is in fact the slope of the trend line upon regressing a stock's returns on the market returns. The model would look like this. All set for now. Let's keep in touch as we continue working on key financial metrics using real data. Thanks for your attention and keep up the good work.